Okay, welcome everyone to our webinar on the Secure Act. My name is Courtney Roca. I'm the Client Care Coordinator at Legacy Planning Law Group. Joining us today is Bill O'Leary, owner and attorney at Legacy Planning Law Group. We are a small firm and we focus on estate and elder law. Thank you everyone for joining us, and I would like to now turn it over to Bill.
Well, hello, everybody. Thank you for joining us and fitting us into your busy day. I want to talk about the Secure Act. As all of you, I'm sure, are well familiar by now. Here we are in the middle of May. Secure Act went into effect January 1 of this year. So we've had, what is that, 4.5 months to get up to speed on the Secure Act. Let me tell you what I'm not going to talk about and then what I am going to talk about. I'm not going to talk about how the Secure Act sort of changes things for the account owner, which I think everyone agrees is on balance has been a net good, a net positive. I'm not going to focus on that. I'm going to assume that you're well up to speed on that. What I'd like to do is focus on how the Secure Act changes things once the account owner dies and the IRA is then inherited. That's really where the sort of the estate planning attorney's contribution comes into play. So I want to talk about inherited IRAs, and so hence the title for this talk is Secure Act, Inherited IRAs, A Brave New World, because it truly is a brave new world. So first, I think it would be helpful to take a step back and talk about the types of beneficiaries that we are dealing with inherited IRAs. First, let's go back before the Secure Act. We basically had two categories. One, a designated beneficiary, a term of art defined in the Internal Revenue Code. Well, what was a designated beneficiary? Well, in plain English, it was basically a human being, a person that lives and breathes and has a birth date and a social security number. It does not include some sort of legal entity, like you couldn't name an LLC as a beneficiary. You couldn't name a charity as a beneficiary and have it qualify as a designated beneficiary. Also, if for some reason the decedent's estate was designated as the beneficiary, it would not qualify as a designated beneficiary under the tax code. The one exception to that is with a trust, which inherently is not a human being with a birth date, as long as it was a special kind of trust known as a see-through trust, and I'll get into that. The second category was a non-designated beneficiary. Well, what was that? Well, anything that was not a designated beneficiary. So again, think of the non-human being scenario, charity, estate, and so forth, or perhaps a trust that did not qualify as a see-through trust. Now, after the Secure Act, we basically have those same two categories plus a third category. So we retain the category of designated beneficiary, okay, and it's sort of defined the same, needs to be a human being. We have a new category known as an eligible designated beneficiary that's going to get some special treatment, and then we also retain the non-designated beneficiary category. And as you'll see, the rules really haven't changed with respect to the non-designated beneficiary. So let's talk about this new category, eligible designated beneficiary. There are five types: spouse, minor child, individual less than 10 years younger than the account owner, a disabled person, and a chronically ill person. So let me go through each of those quickly. So the spouse is given special treatment. The spouse will qualify as an eligible designated beneficiary, and I'm going to go ahead and use the term EDB for short, eligible designated beneficiary, and EDB. So a spouse would qualify as an EDB. A minor child would qualify as an EDB as well. Importantly, it is the account owner's child. Grandchildren don't count. It has to be a child of the account owner and a minor child at that. Now, a question that's raised is, how do we determine whether the child is a minor or not? How do we determine the age of majority? Well, the Secure Act says that it is based upon the law of the state where the account owner resided at death. So let's talk about Florida. How does Florida define the age of majority? Age 18. However, what we don't know is whether that age can be extended out to age 26 as the age of majority. And I say that because there is another part of the tax code that the Secure Act did not change. This all is occurring within Code Section 401. 401, the Secure Act changed part of Code Section 401, did not change other parts of 401. And in some of these other parts, there's a provision that says that for other purposes, the age of majority can be extended out to as much as age 26 if the individual is going through schooling, in so many words. So what we don't know is whether we're looking at age 18 or we can conceivably push it out to age 26, which, as you'll see, can have a big difference on that child beneficiary. Individual less than 10 years younger than the account owner. What kind of scenario was that? Well, think of, the account owner that has designated their sibling who's 4 years younger than them as the beneficiary. Well, then the sibling would qualify as an EDB. Or let's say that the couple that's been living together for years and years and years never got married, and they're within 10 years of each other. The disabled beneficiary. So what does disabled mean? How do we define disability? Well, the Secure Act basically adopts the Social Security definition of disability, and there needs to be a fairly high degree of disability. Actually, the statute says that there needs to be an inability to do substantial gainful activity by reason of the impairment that's expected to last indefinitely. So it's a fairly severe impairment, and what we may find is that some people who think, hey, I think I would fall into that category of a disabled beneficiary and therefore can be treated as an EDB and get that special treatment that EDBs are given that I'll talk about in a minute, but then they may be surprised to learn that they don't meet that very restrictive definition of disability. And similarly, with respect to chronically ill, there's a fairly restrictive definition there in the Secure Act, and we might find that to some beneficiaries are surprised to learn that they don't fall under that category of being chronically ill. Okay, now let's talk about the payout rules. So we've identified the different types of beneficiaries in this new category in EDB. Now, how do the payout rules apply to them, and have they changed? So let's go back in time before January 1, before the Secure Act. Well, if we are talking about a non-designated beneficiary, the same rules apply. The same rules apply. So just as a refresher, if the account owner died before their required beginning date, their RBD, which pre-Secure Act was April 1 of the year following the year they turned 70 and a half. Now it's pegged to age 72 instead of 70 and a half. If the account owner died before their RBD, then the payout has to have occurred by the end of the 5th year after the account owner's death. And if instead the account owner died after their RBD, required beginning date, the payout would occur over the longer of either 5 years or the deceased account owner's remaining life expectancy, what we call sort of the ghost life expectancy. And this is sometimes referred to as the at least as rapidly rule, and I'm going to touch upon that. Now, with respect to the designated beneficiary before the Secure Act, the payout would occur either over 5 years, or if the beneficiary so elected, could take advantage of the stretch, the glorious stretch. Again, that was pre-secure, okay? Now, what about the payout rules after the Secure Act? After the Secure Act, well, non-designated beneficiary, the rules are unchanged. The only difference is we now have a new RBD, required beginning date, which is pegged to age 72. Now, with respect to the designated beneficiary, substantial change has occurred. As I'm sure you know, the stretch is gone. The stretch is gone for the designated beneficiary. Now the payout has to occur over 10 years. So by December 31 of the year that contains the 10th anniversary of death, the money needs to come out. So there is no RMD requirement for the designated beneficiary. The only required distribution, if you will, is that it has to be liquidated by the end of the 10th year. Now, a question has been raised, which is, well, this at least as rapidly rule that applied before the Secure Act went into effect, which said that if the account owner died after their RBD, can the beneficiary take it out at least over what that deceased account owner's remaining life expectancy would have been, the ghost life expectancy? Does that still apply post-Secure Act? Does that still apply? Okay, because after all, we have a 10-year rule. Okay, so does the 10-year rule apply regardless? Because again, what the Secure Act does, it basically does away with this distinction of looking at whether the account owner died before the RBD or after the RBD. That sort of is an irrelevant question now. It's just a straight 10-year rule. But the at least and rapidly rule is still in Code Section 401 and was not changed by the Secure Act. So the question is, does that still apply? We don't know. We're going to wait on further guidance from the IRS, but sort of the pundits believe the answer will be yes, that the at least and rapidly rule will still apply. This would be important because under the new life expectancy tables that will go into effect next year, 2021, the ghost life expectancy for an account owner who dies between ages 73 and 80 will be longer than 10 years. So if the at least as rapidly rule still applies, then a designated beneficiary of an IRA that comes from a deceased account owner that died between ages 73 and 80 will be able to have a longer period than just 10 years. The downside, though, is whereas under the 10-year rule, the beneficiary can wait until year 10 to take it out. If they instead sort of follow the at least as rapidly rule, they are going to be subject to RMDs, okay, over that ghost life expectancy. And then with respect to the eligible designated beneficiary, the EDB, what are the payout rules that apply there? Well, with respect to the spouse can stretch the distribution. So the stretch is available. What about the minor child? Well, again, yes, the stretch is available, okay? But only up until the age of majority. Only up until the age of majority, okay? Then at that point, the 10-year rule comes into play. Now, here's a question. Let's say that the minor child at the account owner's death is a minor, but then becomes disabled before reaching the age of majority, 18. So they get into a car accident and they become disabled, okay? Well, as a minor, once reaching majority, they then revert to the 10-year rule. But if they become disabled, can they continue to stretch it over their life expectancy? Because as you're going to see in a second, a disabled person can take advantage of the stretch. And the answer is yes, that they will be able to do that. And this is an exception to the general rule that in order to qualify as a disabled EDB, the disability must be in existence at the time of the account owner's death. Now, with respect to the beneficiary that's less than 10 years younger, then yes, the stretch is available, okay? And then the same applies for the disabled or chronically ill beneficiary. The stretch is available. Now, what I'd like to do is for a minute talk about the concept of a successor beneficiary. What is this? Well, a beneficiary inheriting an IRA is able to designate a beneficiary that comes up after them if that original beneficiary has not taken all of the money out from the inherited IRA. That is what we call a successor beneficiary, okay? So now let's talk about how the successor beneficiary rule applies to designated beneficiaries under the Secure Act. Well, the designated beneficiary has to take it out over 10 years. Let's say that they are 6 years into that 10-year period and the initial beneficiary dies. What does the successor beneficiary do? They come and step into the shoes of the initial beneficiary, and they have 4 years remaining. So they can sort of step into the shoes and fill out the remainder of that 10-year period. And by the way, this same result applies even if the account owner died before the Secure Act went into effect, so that then the original beneficiary named by the account owner had elected the stretch. So let's say you have an account owner that died June 1st of 2019 before the Secure Act, and their 50-year-old child was named as their beneficiary of the IRA. And that 50-year-old child took it as an inherited IRA and elected the stretch, which they could do back in 2019. But then that 50-year-old child dies in the year 2022, okay, 2022. So they're only 2 years into their long stretch distribution period. Well, the successor beneficiary, if they name one, does not get to step in their shoes and fill out the remainder of that stretch period. They then, the successor, is subject to a 10-year period. Now, with respect to the eligible designated beneficiary, they can name a successor as well, and the successor will come in and have to take it out over 10 years. So even though the EDB is able to stretch it, if they die before they've taken out everything from the IRA, their successor beneficiary will step in and instead of being able to continue that stretch, will now be subject to the 10-year rule. And that is the case even if the successor beneficiary is also an EDB. Okay, so you have the primary or initial beneficiary is an EDB. And let's say that they have named, let's say it's a spouse, okay, but then the spouse names a successor beneficiary after them, and let's say it's a disabled child, and the spouse has elected the stretch, which the spouse can do as an EDB, and the spouse dies prematurely. Well, does the disabled child, which on their own merits qualifies as an EDB, do they get to continue the spouse's stretch? And the answer is no. They are now under the 10-year rule. Okay. So the next slide is just sort of a visual depiction of how a trust works. So now I want to talk a little bit about this whole concept of a see-through trust. So here you have the IRA itself, and instead of money being paid out to the individual beneficiaries, it instead is being paid out to a trust. And then the individuals are beneficiaries of the trust instead of beneficiaries of the IRA. Okay. So now what I'd like to do is talk about the see-through trust. Okay. Before getting into how the Secure Act has affected the use of see-through trust as IRA beneficiaries, let me take a step back and ask the question: why would you ever even name a trust as the beneficiary of an IRA? Well, first and foremost, creditor protection. Creditor protection. Naming a trust as beneficiary of the IRA instead of an individual is a great way to protect the inherited IRA from the beneficiary's creditors. Well, what sort of creditors am I talking about? Divorce and lawsuits are the two biggest. The child getting divorced or the child getting into a lawsuit because they got into that bad car accident and it's their fault and they killed somebody. And the reason why creditor protection has taken on such great importance in IRA planning is because of a court case that came out back in 2014 from the U.S. Supreme Court, case called Clark v. Ramaker. Clark v. Ramaker, where in a 9-0 decision, all 9 of the justices held that an inherited IRA is not protected from the IRA beneficiaries' creditors if they find themselves in bankruptcy. And so because of that, After the Secure Act, creditor protection is now, in my judgment, the primary reason why you might consider setting up a trust as the beneficiary of an IRA. Before the Secure Act, you basically had two objectives or two motivations for using a trust. Number one, the creditor protection was equally valid as a reason before Secure as well as now. But there was also an objective before the Secure Act went into effect, which was a sort of a tax planning goal, which was to make sure that your children would take advantage of that, being able to stretch that payout over their life expectancy. Okay. Well, now that the stretch is gone for most beneficiaries out there, then that's no longer really a reason to consider using a trust. But creditor protection was an important objective and remains an important objective or reason to use a trust. Another reason may be to provide prudent asset management. Let's say that the beneficiary is a spendthrift. They have a hole in their pocket. Well, a trust is a good way to protect that IRA inheritance for the beneficiary. Perhaps protecting a deceased account owner's assets, the IRA, in a second marriage, where maybe the deceased account owner had children from a prior marriage, able to use a trust to make sure that the IRA is going to be benefiting the new spouse for the rest of his or her life, but that the new spouse is not going to be able to just take the entire IRA for themselves, but rather there'll be something left in that IRA to go back to kids from the prior marriage. If there are minors that are going to be beneficiaries of the IRA, well, using a trust will avoid the need of having to go down to court and open up a guardianship for them. And then something very interesting, avoiding the 10-year payout failure. And I actually came across this reading a recent Ed Slott newsletter, and he pointed this out as a reason why a trust is a useful tool. Well, if there is not a trust as the beneficiary, but instead just an individual, then that individual may blow the 10-year payout deadline. And according to Ed Slott, he said that these custodians aren't obligated to be sending out a reminder notice in the fall of year 10 saying, hey, the 10-year deadline is coming up. And as you know, there's a 50% penalty for missing that payout deadline. And then lastly, another reason to consider using a trust is to ensure that a successor beneficiary will be named. I talked about the importance of an initial beneficiary naming a successor beneficiary. So, if there's no completed form filled out by the inherited beneficiary, the initial one that names a successor beneficiary, then the IRA custodian's default rules will apply to determine who that replacement of a successor beneficiary is. So, again, a number of reasons why the use of a trust may make a whole lot of sense. Now, what I'd like to do is talk for a minute about see-through trust, the requirements, and then the types. Well, a see-through trust to be valid needs to meet 4 requirements. It needs to be valid under state law. That's usually pretty easy. It needs to be irrevocable at the account owner's death. Usually pretty easy. All beneficiaries must be identifiable. So sometimes that's a challenge. And then, and this is where the advisor often comes in to help with the process, the trust documentation needs to be provided to the custodian by October 31 of the year following the account owner's death. With respect to the types of see-through trusts, are basically 2 types, a conduit trust and an accumulation trust. Well, what's the difference? With a conduit trust, all money taken out of the IRA, whether it's an RMD or other monies taken out of an IRA, withdrawn, need to be distributed back out to the beneficiary. In fact, the trustee is required to distribute it back out. So the trust is simply a mere conduit, sort of a flow through, okay? Now, the good aspect of a conduit trust is that it is very tax efficient. Why? Because since the withdrawals from the IRA must be distributed back out to the beneficiary, those monies, that income is taxed to the beneficiary at much more favorable tax rates that apply to individuals, as opposed to it being taxed to the trust, which has very unfavorable tax rates. So it's tax efficient. That's a good use or a good reason or a benefit that a conduit trust provides. A downside is loss of control. So once the money is distributed back out of the trust to the beneficiary, then it's exposed to the beneficiary's creditors and creditors. An accumulation trust, on the other hand, is a trust that says any money that's pulled out of the IRA and is paid to the trustee is not obligated to pay it back out as it would be in a conduit trust, but rather the trustee has the discretion to keep it inside the trust, to accumulate the income, to retain it inside of the trust. Well, a benefit of an accumulation trust is that it provides more control and protection of the asset from the beneficiary's creditors and predators. Again, think of the divorce or lawsuit. But a downside of an accumulation trust is that it is very tax inefficient. Why? Because if money is trapped inside of the trust and not distributed out to the beneficiary, it's taxed to the trust, not to the individual. And a trust has very unfavorable tax rates. Income earned by a trust is taxed at the highest tax rate of 37% when trust income reaches $12,950. So that means that the first dollar above that is taxed at 37%. Compare that to an individual where the highest tax rate isn't hit until, for an individual, over $518,000 of income, and for a couple over $622,000. So there's good and bad with both the conduit trust as well as the accumulation trust. So how were these two types of trusts used before the Secure Act? Well, the conduit trust was clearly the most common kind of trust used. It was sort of the go-to trust that was used as the beneficiary of an IRA. Why? Two benefits, as I mentioned. Number one, the creditor protection. The creditor protection, protected from the divorce and lawsuit. And two, it provided the tax planning benefits, forcing the child to take advantage of the stretch. The accumulation trust was not used that often, mainly because of the tax disadvantage, because of those really compressed tax brackets that a trust has, where it hits the highest tax bracket at about $13,000 in income. And so really accumulation trusts were used primarily for special needs trust, where an accumulation of income inside the trust was necessary to avoid disqualifying the special needs beneficiary from government benefits, because if instead the money was forced back out to that special needs beneficiary, as it is with a conduit trust, then that could very well disqualify the beneficiary. So before the Secure Act, the tax inefficiency was considered to be an acceptable trade-off to be able to preserve government benefits. And usually in the case of a special needs beneficiary, there were a lot of sort of health-related and medical expenses that could be deducted against the income. So the tax hit was not as great as you might think. Now, with respect to see-through trust after the Secure Act, how has the Secure Act affected the use of special needs trust? Well, it is a different paradigm now. It is a different paradigm. So let's first talk about the category we call designated beneficiaries, which covers by far most beneficiaries out there. A conduit trust is bad. A conduit trust is bad. Why? Because a conduit trust requires any money that's withdrawn from the IRA to be distributed back out to the trust beneficiary. Okay? Now, bear in mind that with the Secure Act, these designated beneficiaries are under the 10-year rule. There are no RMD requirements, no RMD. So the only required distribution, if you will, is that one lump sum distribution at the end of year 10. Now, the beneficiary can take out more, or at least the if it's a trust, the trustee can take out more, you would like to think. But it all depends on the nature of that conduit trust. Not all conduit trusts are made the same. Okay? So some conduit trusts are drafted to say the following: the trustee is to take the RMD from the IRA, but is not allowed to withdraw any additional amounts. Period. So those are very tightly drawn conduit trusts, and those were used to really force the child beneficiary, let's say, to take advantage of the stretch. So did not want to give the trustee, who often was the child themselves, the ability to take out more than the RMD, because that would sort of blunt the tax benefit of being able to stretch it. So there are tightly drawn trusts like that. Well, what does that mean then? That means that the trustee is not allowed to take any money out before December 31 of year 10. In those kinds of tightly put together trusts, the trustee is not allowed. So there'll be one distribution and one distribution only at the end of year 10, which of course is going to result in a huge tax bill, as well as a ton of money coming out at one time that will be exposed to the beneficiary's creditors. On the other hand, there are some kinds of trusts out there, conduit trusts, that aren't so tightly drawn, so tightly drafted. Some will say that in addition to the RMD, the trustee is allowed to withdraw additional amounts, let's say for the beneficiary's health, education, maintenance, support needs, that sort of thing. If that is the way the conduit trust is put together, then you might be able to get away with sort of continuing on with a conduit trust as the beneficiary of the IRA, because at least there the trustee has the flexibility to take out additional amounts. Maybe you can sort of space it out over the course of 10 years, take out some each year to sort of spread out the tax liability, and also to regulate the withdrawals of money depending upon the beneficiary's life circumstances and creditor risk. So, but still, having said that, generally speaking, conduit trusts are considered to be a bad trust planning solution for IRAs after the Secure Act. On the other hand, accumulation trusts are considered to be the much better approach. And really, the reason being is that this would allow the trustee to pull out any amounts from the IRA at any point over that 10-year period. The trustee could decide to keep that money inside of the IRA or distribute it back out to the IRA, depending on the beneficiary's circumstances, okay? Again, the only downside there is the compressed tax rates, but generally speaking, for the broad category of beneficiary we call designated beneficiaries, conduit trusts are bad, accumulation trusts are good. Now, with respect to this new category of beneficiary known as eligible designated beneficiaries, let me first focus on 3 of the 5 types of EDBs: the spouse, the minor child, and the beneficiary who's less than 10 years younger. Here, it's the opposite of what I just talked about. With the regular DB, designated beneficiary, the conduit trust is a bad idea, the accumulation trust is a good idea. Here, we flip it. The conduit trust now for these types of EDBs is a good result. Why? Because it allows this EDB to stretch the inherited IRA. Whereas if instead the trust that is used as beneficiary of the IRA for these types of EDBs is an accumulation trust, that is bad, because in that case, the EDB will not be able to take advantage of the stretch, and instead will be subject to the 10-year rule. Now, having said this, let's talk about a see-through trust for a spouse. Again, commonly done in a second marriage situation where the see-through IRA trust is sort of combined with a very commonly used type of trust for a spouse in a second marriage called a Q-tip trust, okay? Again, the idea is that the new spouse will benefit from the trust but not so much so where he or she can take everything out. And then with respect to the see-through trust for the minor child, again, the conduit trust is good because they can stretch it. But remember, they can only stretch it until the age of majority, and then they have to take it out over 10 years. So assuming the age of majority is 18, we'd be looking at age 28 where everything needs to come out. And some parents may not want the entire IRA paid out to their 28-year-old child because they may feel that's too young for them to be able to effectively manage assets. So some parents may say, look, I'd rather use an accumulation trust for my minor child. Yes, it won't be quite as tax efficient, but at least there, the trustee will have the flexibility to keep the money inside that trust if my child at 28 isn't quite ready for the money. And as a planning note, with respect to an account owner that has minor children, and wants to use a trust as beneficiary, and decide, for the minor kids, I'm going to use a conduit trust so they can take advantage of the stretch until they reach age of majority. What they would be smart to do is that once the kids reach the age of majority, is to come in and revisit the planning and change the type of trust that's being used as IRA beneficiary from a conduit to an accumulation, because once they reach majority, those kids are no longer EDBs, but now they're just a regular DB, designated a beneficiary, where if that conduit trust continues, now there are creditor exposure to the child. So then they may want to change that to an accumulation trust. With respect to the next category, I'm going to combine these two categories of EDBs, the disabled and chronically ill. The reverse is true of what I just talked about, okay? So with the previous slide, I'll put back up here, the spouse, minor child, and the less than 10 years younger beneficiary type of EDB, a conduit trust was good, and an accumulation trust was bad. The reverse is true now for the disabled and chronically ill. The conduit trust is bad, and the accumulation trust is good. Reason being, with a conduit trust, this type of EDB cannot take advantage of the stretch, whereas with an accumulation trust, they can take advantage of the stretch, okay? And the question is, why are these two types of EDBs, disabled and chronically ill, treated differently than the other types of EDBs? Really, it represents a concession to the disability community. Remember, historically, before Secure, accumulation trusts were used for special needs planning, special needs individual, so as not to disqualify them from government benefits. And if the Secure Act came in and turned that on its head and said the only way a disabled beneficiary can stretch it over their life expectancy is to use a conduit trust, that would defeat the whole purpose behind trust planning for a special needs individual, which is to make sure that the money in the trust is not going to be forced back out to them and thereby disqualify them from government benefits. Okay, now I want to take a minute and I want to talk about the this concept of a multiple trust beneficiary, okay? This is the area of the Secure Act where there is the most uncertainty, okay? The question is, if you have a trust that is the beneficiary of the IRA, and the trust has multiple beneficiaries of the trust, then when is the stretch available and when is it not available, okay? Well, let's first take the scenario where some of the trust beneficiaries are designated beneficiaries, DBs, and some are EDBs, okay? So the general rule says in that situation where you have some DBs and some EDBs, the stretch is ruined. Okay? So think of this situation. You've got a trust that's beneficiary of an IRA. And the trust beneficiary consists of two children, okay? One of whom is a 14-year-old, a minor child, and one of whom is a 26-year-old, not a minor. The 14-year-old is an EDB, and the 26-year-old is not an EDB. So does the 14-year-old get to stretch it over their life expectancy? The answer is no. It's ruined for the 14-year-old. Or let's say that child was disabled. It's ruined because the presence of a designated beneficiary ruins the stretch for the EDB beneficiary. So what is the solution? What is the solution in my judgment? It's to not name the trust itself as the beneficiary of the IRA, but instead name the individual sub-trusts as beneficiary on the beneficiary form. So if you have a master trust that at death is going to be split into two smaller sub-trusts, one for child A and one for child B, then use a custom beneficiary designation on the beneficiary form to designate both of those sub-trusts. That does work, and that's worked for quite a number of years under previous IRS guidance. Now, there is this concept known as an applicable multi-beneficiary trust, okay? If one of the EDBs is disabled or chronically ill, then they will be able to continue to stretch over their life expectancy, even if we just have the master trust as the beneficiary of the IRA, and we have not come up with that custom beneficiary designation. What if we have the second scenario where all of the trust beneficiaries are EDBs, but none of them are disabled or chronically ill? None of them are disabled or chronically ill. Well, can those EDBs then stretch it over the life expectancy? And the answer is, we don't know. We need further guidance. That's why I said that situations where a trust is beneficiary of the IRA and the trust has multiple trust beneficiaries, that's the area of the most uncertainty. You know, there's one view that says there'll be no stretch at all because the statute refers to an EDB in the singular and not to a group of EDBs. I think that's kind of short-sighted because the IRS has long allowed multiple beneficiaries to stretch over their separate life expectancies when a custom beneficiary designation form was used. There's another view that says, yes, the stretch will be available for those EDBs and each one can use their own life expectancy. But again, I don't think that's going to be the best view because the IRS really has never allowed each individual beneficiary to stretch over their separate life expectancy when the master trust was named on the beneficiary form instead of that custom beneficiary form. The third view, which I think is the best view, that says yes, in that situation where we have all EDBs as trust beneficiaries, each of them will be able to stretch, but they'll all be pegged to the oldest beneficiary and thereby have the shortest life expectancy. That's the view that Michael Kitsis and Natalie Choate share, and I tend to agree with them. But again, we don't even need to go there if instead we use a custom beneficiary form. And this is going to be a takeaway from this talk. Use a custom beneficiary designation on the beneficiary form. And the last category, let's say we have that all of the trust beneficiaries are EDBs and at least one or more of those are disabled and chronically ill. The disabled and chronically ill EDB can stretch, but the other EDBs cannot. But what's the solution there? Don't name the master trust on the beneficiary form. Instead, use this custom beneficiary language. And on the next slide is an example. Here we go. Oops. We'll go back. The mouse is not being responsive here. There we go. So this is sample language that I use for that custom beneficiary form. So I have a long form, a shorter form, and a shortest form. Well, the long form at the top is the preferred language to use on the beneficiary form because it's taken pretty much right out of some IRS private letter rulings. So it's been blessed by the IRS. But I have a shorter form and a shortest form, if a custodian can't accommodate all the words in the long form. And again, what this does, it avoids all the problems with multi-beneficiary trust and so forth that you run into problems and you end up shortchanging certain beneficiaries if you name the master trust as the beneficiary on the designation form. Instead, it's much better to use a custom designation form. So as I go ahead and bring this to a close, just a couple of thoughts, sort of the advisor's game plan could be, well, do an inventory of your client's beneficiary designations and see which IRA designations designate a trust. And then from there, you may want to triage and create two categories. One, those that name a trust as the primary beneficiary, and those that name a trust as a contingent beneficiary, and focus on the primary beneficiaries first. And then from there, look closely at the trust. Drill down. Are any of them conduit trusts? And if so, which ones are the tightly wound or tightly drawn type that only allow the trustee to take out the RMD and nothing more? That's the train wreck about to happen. Or do any of them allow for discretionary withdrawals by the trustee over and above the RMD? And then lastly, with respect to planning options, Roth conversions, I'm not going to go into that. I think we're going to see more and more of that. Life insurance perhaps is a tax-free source of funds to help pay the tax, and so the policy maybe could be paid to the beneficiary, maybe paid to the see-through trust, or we might see sort of a resurrection of the old-fashioned ILIT, the life insurance trust, where maybe you can have the policy owned by the ILIT, and then at death, the policy is paid out to the ILIT with instructions to that ILIT trustee to take that money to pay the tax in year 10. Charitable remainder trust, is a solution for somebody who's charitably minded. And the thought here is that the CRT will mimic the stretch that has been lost for most beneficiaries, where an income stream can be created to a human beneficiary, such as the kids, over their lifetime or for a term no more than 20 years. It could be based on an annuity or a unit trust payout, let's say 5% of the trust assets. The IRA then would be paid out to the charitable remainder trust at death tax-free. The trustee of the CRT then would go ahead and invest the money, and then as distributions are made out to the beneficiary, that annuity or unit trust payment, it's generally thought that there'll be less tax that's ultimately paid to the IRS, because instead of that beneficiary just receiving distributions straight from the IRA, which is all ordinary income, here a CRT is subject to certain ordering rules where, depending on how the trustee invested the assets inside of the trust, some of that income may be ordinary income, some may be taxed as capital gains, some as taxes exempt income, and perhaps some as a return of principal. So on a blended basis, the tax burden may be less. And then ultimately, the charity will get the remainder. And so again, a CRT might be appropriate for somebody who's charitably minded. And then lastly, something we call a spray trust, a pot spray trust. So perhaps naming a trust as beneficiary of an IRA, but it is a pot trust where it'll go into one big pot for multiple beneficiaries instead of the way we've historically done it, where that trust would break out into separate buckets, each for their own beneficiary at death. One bucket is created, and the trustee of that trust has the flexibility to sort of sprinkle out income to different trust beneficiaries, depending on their tax situation. Maybe if somebody's in a lower tax bracket, maybe sprinkle out more income to that beneficiary, and maybe the client can to try to equalize inheritance, create a separate trust that's going to be used. So whereas if the pot trust for the IRA ends up distributing more money out to one child over the other, then maybe this other trust can be used to equalize things for the other. So just some ideas, planning options that you might want to consider. And then in closing, before I turn it back over to Courtney, just wanted to let everybody know about two exciting programs that we have officially rolled out in the past few weeks. On the left is what we call our family estate and legacy program for the estate planning side of the practice. It's a 7-step or 7-module program. And so it's a nice visual that we show clients that shows them the beginning of the journey, each step along the way, and then at the end of the journey. And it gives them clarity it gives them clarity as they go through a process that otherwise may be new to them or foreign or mysterious to them. We've gotten great feedback. And then the estate settlement program on the right, so this is our post-death administration practice, a similar 7-step process that we will show the family and say, these are the steps we're going to go through as we administer your loved one's estate or trust or whatever it might be. So we're very excited. They've been very well received by clients, and I very much believe in process. And so with that, I'm going to go ahead and turn it back over to you, Courtney. And why don't you go ahead and close this out?
All right. Well, thank you everyone for coming. If you would like to get a hold of us, you can do that by calling us at 904-880-5554. Or you can visit our website at legacyplanninglawgroup.com to get some answers on maybe some other things. Or you can even schedule a 15-minute call with one of our team members at www.legacyplanninglawgroup.com/book-a-call. We also are doing virtual meetings right now with COVID-19. We have started doing them, and they are actually really successful. So if you have a client that isn't ready to kind of venture out into the world, we can accommodate that as well. So as I said, thank you for joining us. And I will also show you our team. This is our team that Bill surrounds himself with, which is a group of lovely ladies. And he's actually survived having all of us in the office with him during this time. And anybody on the team can answer any of your questions, and we'd love to talk about your client's particular situation. So if you need to reach out to us, please remember our number is 904-880-5554. And thank you, and you have a good day.
Thank you.